It is February, but why does it still feel so much like January? Not the snow piling up, stocks going down and starting this month pretty much right where they left off last month, and market averages careening closer to an official correction. Welcome, everybody. I'm Neil Cavuto, and with the Dow's nearly 324-point sell-off today, its seventh triple-digit drubbing this young year. It is now off more than 7% from its highs. The technical definition of a correction is 10%. Japan's already there, courtesy another tumble in its Nikkei average overnight. That's like our Dow, which hasn't seen such a thing in years. So some experts say we are due, long overdue, even as some investors say we are doomed, very doomed. And a chill in manufacturing last month didn't do much to help. All 10 main sectors in the S&P 500 in the red today, which prompted no less than industry legend Jack Bogle to do a little investor handholding today. His best advice for nervous folks, well, sit tight, ride this out, or as Market Watch very nicely put it, don't do something, just stand there. To our Sandra Smith on something that's a lot easier said than done, I suspect. Sandra?
That's right, Neil. This was the second 300-plus point sell-off for the Dow Jones Industrial Average so far this year, and we're only in the first day of February. So there's a popular belief on Wall Street right now that record run-up in stock prices in 2013 was directly the result of the Fed's money printing policies. And now that the Fed is unwinding its stimulus program, well, down goes the market. So says market strategist like Mike O'Rourke of Jones Trading. He told me today that the Dow is likely to fall another 5% lower from here. The Dow fell triple digits out of the gate this morning. We had weak reports on the economy, including U.S. auto sales, as well as some weak U.S. manufacturing data. And then the selling picked up midday. Investors were running for the exits. The Dow plunged more than 300 points and finished up right at its lows of the session, down 325 points on the day. But it wasn't just the Dow. The S&P, the NASDAQ, the tech-heavy NASDAQ suffered its first 100-plus point drop since November 2011. Investors were fleeing stocks for the perceived safety of U.S. government debt. The yield on the 10-year Treasury fell to its lowest level in 3 months, below 2.6%. And in the stock market, investors were seeking shelter in typical safe havens such as utilities, but even they were not spared. Utilities tried to muster a gain, but still fell on the day. The worst Dow performers in this big sell-off, Neil: AT&T, Verizon, two telecom names leading the way down for the Dow: Microsoft, 3M, and Disney. And Neil, at the top of this hit, I said how this is the second 300-plus point sell-off for the Dow this year alone. Well, we looked back at all of 2013 and all of 2012, and there was only one 300-plus point sell-off for the Dow in both of those years combined. So this is a pretty dramatic move to the downside.
You know, Sandra, there's still a number of analysts who say even with today's fall off and even with the 7+% drop from our highs, this is still a rich market. I guess it's in the eye of the beholder, but what are you hearing?
Well, there are those that say that a correction of some sort, which would be a 10% drop from the highs, is somewhat necessary for this bull market to continue. It's sort of a sign that it could be a stronger rally. And a lot of analysts who are calling for the stock market to end 2014 higher say they'd actually like to see this sort of sell-off. They would call it healthy for the market. So I guess you could lean on that if you're thinking that stocks are going to continue to go higher from here.
All right, we'll see. Sandra, thank you very much.